Hi, I'm Graeme Carson from RaaS Research. Today we're discussing Verbrec Limited, and I'm joined by Group CEO Mark Reid. Welcome, Mark.
Welcome, Graham, and welcome, viewers. Great to be here today.
Okay, look, it's a great time to be discussing Verbrec. You've made some pretty material announcements over the past couple of months. But before we go into that, with divestments and acquisitions, can you give us a brief overview of the Verbrec engineering business as it stands today in regard to maybe the footprint and the type of work that you do and the industries you service?
Yeah, sure, Graham. So, look, Verbrec's a pretty unique professional services company. We operate across Australia and New Zealand and into the Pacific, and our core markets are around energy, around mining, around water infrastructure, as well as defence. We sort of we Verbrec, the word comes from a Nordic word meaning person of strength. So that's very much our mantra. And the Verbrec business started as two companies, Logicams and another one, OSD, merged together in 2019 to form the Verbrec we've got here today. Logicams really had a background in automation and control and asset management, and OSD around pipeline engineering, slurry pipelines, water pipelines, and operations and maintenance. So that was the formation of the company. We offer a full asset lifecycle offering to our clients. We think that makes this very unique. We'll do the studies and we can do the engineering. Then we can do the oversight of construction. We can then move into operational readiness and asset management, and then do the operations and maintenance. For example, we operate and maintain about 2,000 kilometres of gas transmission pipeline at the moment, for example. And then we can do decommissioning, and we also have some specialist products. One's called Staxon, which is a software package that manages stockpiles. So what we find there is that gives us a very, very strong connected relationship with our clients over the entire life cycle of a project or of a client life cycle. And what that really means is that we have 20 key clients that give us about 70% of our work, and we're very proud of how strong those relationships are with those clients. And our mantra as a business is all about being a valued partner of our clients as they go on their journey of sustainability. Is very much the mantra we work to. At the moment, we're of the order of 400 employees. Most of those are billable, and those are our assets. That's what we provide. Those assets walk out the door at about 5:30, and hopefully they come back the next day. In terms of contracts, probably 60% of those contracts are sort of time and material schedule rates, whereas 40% will be fixed price. And we've had a look at that over time, and it's shifted a little bit, but that's about the mix. A lot of panel agreements with those relationship clients, 43 panel agreements, and we have 12 multi-year agreements, particularly in that operations and maintenance space, where those agreements tend to run more than 1 or 2 years. In terms of where we are, and this probably leads into what we're going to talk about next, but growth aspirations are very much organic and inorganic, and we sort of target both. We think a healthy company has a nice mix of inorganic and organic. And really, probably the other point is just to note that we've been able to repair our balance sheet and the performance of the business over the last couple of years. We're now generating good cash, and certainly we've identified opportunities to accelerate the growth, given that we're now in a much stronger financial position.
No, absolutely, Mark, that's showing through in the numbers as well. But over the past month or two, you've made some pretty significant announcements in regard to a divestment and an acquisition, and that really do reshape what the business looks like going forward. Engineering's always been the lion's share of your revenue, but you did have a training business as well in competency training, which you have announced you're divesting. Can you tell us the thinking behind that decision and the benefits to your group on the back of it?
Sure. So CT, competency training, so training business operates in the high voltage area and in some hazardous areas. It's a business that we're very proud of, and still are proud of it. It's certainly grown larger and more profitable over the last couple of years. And we were approached by a very reputable global training business called Rely On, that's owned by Mubadala, the Abu Dhabi sovereign wealth fund. And they're fairly aggressively buying up training businesses. That's very much their business model around the world. We sort of got to the point where we looked at the sort of offer that they'd unsolicited offer they'd made to us, and look, right time, right place, right price, and so it really allowed us to sell that business to a group that I know will continue to grow that business within their operational regime. And give us additional funds that we can redeploy on the other opportunities that we'd identified. So it really was a great stepping stone to being able to do a lot more with our cash in a lot of other areas. We think that will sort of complete sort of December this year, probably very early this year.
Yeah, okay. Well, that leads you to the obvious next part of the discussion, which is your recent acquisition, a company called Alliance Automation. It looks like a great acquisition on many levels for you at an exceptional price. So what attracted you to that business, and how does it change the face of the Verbrec group overall?
Sure, yeah. Yeah, look, very, very excited to talk about this one, Graeme. Alliance Automation, we've known Alliance Automation for a long time. We've understood them, we've seen them in the marketplace. They have been at times in the same space as our legacy Logicams business. In truth, as they perform very well in the marketplace. About 4 years ago, Telstra Purple bought this business, and it was part of Telstra's 2025 strategy at the time. When Telstra revisited their strategy and drafted their Connected 30 strategy, as they call it, the business was seen as then non-core to Telstra. So that gave us then the opportunity to engage with Telstra in terms of purchasing that business. The thing that excited us about it, and there's a lot of things to be excited about, I've got to say, but the first one is very similar cultures, very similar client-first philosophies, similar histories. They were actually started in about 2010, and they grew a business from a startup 15 odd years ago to being a very strong business that they are today. In those days, pre-Telstra, their EBITDAs margins were 7 to 9%. Pre-Telstra acquisition, it gives us a lot of benefit. It's in that space, that automation control space, the AI space, the machine learning, cybersecurity, all those sorts of areas that are absolutely critical to our businesses and our clients that we work with at the moment. So that gives us additional services that we can provide to those clients, very much along our strategic lines. A lot of synergies, with clients, with technologies, with geographies, a lot of things to like. Really, the sort of mantra now becomes, how do we make the revenues 1 + 1 = 3? So the top line revenues, how do we continue to extract those synergies of the broader business? Likewise, at the same time, looking at the cost side and saying, well, 1 and 1 hopefully only makes 1.5. So we get the revenue gain and we get some efficiencies. Some of those efficiencies, for example, like office mergers and sort of some systems and processes, those sorts of areas. Just going back to comments before, I mean, they really are at the forefront of that sort of OT, IT interface, Industry 4.0, the machine learning, cybersecurity, AI support. So it brings us a lot more capability in that space, and also areas to play, including data centers where they work. So a couple of metrics on their business. About 275 staff, 12 office locations. So we get some additional offices as well. So we have additional offices where our clients are as well, which is great. And again, we hope to complete that at roughly the same time as the CT divestment, around about sort of start of December.
Yeah. Okay. Great. Now, you spoke about the margins in the Alliance Automation business a period of time ago, and you think that there's an opportunity now to release value in that business as the margins have contracted. You can't help but notice some parallels with the traditional engineering business you inherited at Verbrec when you took over 2 or 3 years ago. Now, at that point in time, I think Verbrec was loss-making at the EBITDA line, and revenues are around about 100 million. In the last 2 years, since FY23, you've now improved to deliver EBITDA margins above 9% on revenue that's a little bit lower, around 80 million. The Alliance Automation business is doing EBIT margins closer to 3% at the moment, but again has a significant revenue base of over 60 million. So do you see a similar opportunity to improve this performance even before we talk about leverage to the upside with synergies on a combined group?
Absolutely, yes. As you point out, Graeme, Verbrec's been on a journey over the last sort of 3 years, and certainly businesses, professional business like ours, are very able to make 8 to 10%, and that's what we've shown. Alliance Automation is fundamentally a strong company, and I think to your point, the pre-Telstra profit margins do demonstrate that. And it's very much our intent to return that group to the 8 or 10% EBITDA over sort of circa the next 18 months, and that will be done, as you say, by finding ways to be smart about cost base. But there will be the synergies as well that enable us to get extra growth as well. So it's sort of the two sides of the coin, really, isn't it? You know, let's keep winning the work from the key clients. For example, there'll be some clients we both Verbrec and Alliance have traditionally worked for. That's great because there's almost no overlap, so we can continue to build that offering with those clients. But there are also some clients where the Verbrec business worked with them, whereas Alliance didn't, and vice versa. So that gives us another opportunity for growth. Certainly cost control and non-labour overheads, you know, in both Verbrec and AA, Alliance Automation, we'll continue to focus on. I think the other area you touched on there a little bit, and part to the slight reduction in revenue we got with Verbrec as we improve the margins. There are some projects that maybe some projects perhaps we're involved in that, with the benefit of hindsight, we're never going to make us a lot of money, and so there's a little bit of due diligence and discipline around that, and also in project control discipline as well to make sure the projects we have are delivered well, and that's both in the Verbrec and the Alliance Automation side.
Yeah, I mean, that's one thing that stands out, I guess, over the last couple of years with Verbrec is that the cleanliness of the results, which isn't a given in a lot of engineering business. So that's very commendable. So now from here, you've made this acquisition at a very good multiple of between 2 and 5 times EBITDA, depending on how you cut the numbers. You're cash flow generative. You're selling the training business, which nets you 11.5 million in cash. Haven't got any significant levels of debt. So you've actually got more balance sheet capacity probably to make more bolt-on acquisitions if you so choose. Is that still part of the strategy at the moment?
Yes, it is. In short, just a few words on the cash position. You know, post the transactions, both the transactions, Verbrec will have approximately 18 million dollars of cash available, and less than 10 million in debt. So call it 9 million in debt. So we've got a net cash position to the tune of 9 million dollars, and just as important, or arguably more importantly, a positive cash from operations. So we'll continue to keep building that cash reserve. So yes, acquisitions are certainly on the radar, and as is ways that we can do organic growth as well, and investment in people, for example, and technologies. And we do talk to a lot of industry partners. You know, as you'd imagine, we have a lot of discussion with a lot of groups that we'll partner with. Now some of those may potentially be acquisitions. You know, we certainly would be on the lookout and constantly on the lookout for bolt-on acquisitions, for example, to give more depth in the business. There are certain areas of our business where obvious areas where we can look at some bolt-ons at the moment. Asset management is one of those where we can expand our geographic coverage. So geographic expansion, perhaps in some areas where we can use Alliance Automation as a springboard as well, and some of the machine learning areas as well. I should say bolt-on acquisitions are very sensible and certainly part of strategy. It is also critically important that we make sure that Alliance Automation and Verbrec, the merger of those two entities and the improved performance is critical as well. So we can't lose sight of that when we look at some of the acquisitions. But we're doing all of the above. So
Yeah.
yeah.
Now listen. Well, firstly, congratulations on the turnaround of the existing Verbrec business. You look like you've got an exciting acquisition. The company's currently valued a market cap of low 40s with, let's say, net 9 million in cash in the next couple of months. So you've got an enterprise value of the low to mid 30s on a combined basis. 10 million EBITDA is probably there or thereabouts, without having removed a great deal of costs or leverage some revenue synergies in itself. So it looks like a great opportunity. So look, I guess we look forward to further progress on the existing business and the merged business. And hopefully you can release some significant value from Alliance Automation.
Thank you for those words, Graeme. I must say we're really excited about the future. To your point, I think there's a lot of headroom for the business. Can I say we've got an exceptionally good management team that are leading the business exceptionally well, and a quality board as well. So very much looking forward to what the next year or two holds for us.
Likewise. Thank you very much for your time, Mark. Appreciate it.
Thank you.